Is the Fed the ultimate buyer of last resort of treasuries? Yes. But there's an intermediate buyer, which is the U.S. banking system. In the 1950s, a typical large U.S. bank balance sheet was 40% treasuries. That was normal. That wasn't like hoarding. Today, it's about 5 to 7%. So I think you'll get a phone call to Jamie Dimon and all the other CEOs, Jane Meyer and the lady at Citi. They'll call them first to say, people got to buy bonds. And of course, they're all under the thumb of the U.S. government, and they will. So you might have a pretty good cushion of bond buyers before you have to turn to the Fed and expand the Fed balance sheet. Now, especially with positive carry and lever at 10 to 1 under Basel, you can make very good returns on equity. So you do have a large pool of intermediate buyers before you get to the Fed. It doesn't really solve the problem. It just passes it around the banking system. By the way, the Chinese are doing something very similar right now. Everyone's like, why hasn't the People's Bank of China sold more dollars? Well, it's because they're making the banks do it. The commercial banks are selling the dollars and propping up the yuan. And we can see something similar in the United States. So that's one. I just kind of pencil in the commercial banking system, at least the big banks, as potential buyers of not quite last resort, is a way to put it. But the other thing, the BRICS, what they've done, this is part of the brilliance, they've opted out of the exchange market. They're like, because normally if the dollar's getting weaker, you're getting stronger. That's bad for exports. It's bad for export-related jobs, et cetera. And it's currency wars. That was my first book, Currency Wars. But by defining their currency by weight of gold, not dollar amount, but by weight of gold, they're out of the foreign exchange market. Like they can just sit back and watch the show. There are some pools of capital out there that can support the bond market, but then there's an opportunity cost. Like, what else could they be doing? Infrastructure, other kinds of investment. The best safe haven is gold. Let's say physical gold, bullion, coins or bars, and silver. It's not digital. You can't hack it. You can't steal it, and you can't freeze it. They just put it in a safe place. So, but Americans don't really get gold. They don't really understand it. So, yeah, I think it's just going to be a question of frog hopping from lily pad to lily pad, looking for a safe place. The other scenario is that the government just throws in the towel and says, okay, all deposits are guaranteed in unlimited amounts. And I knew people who were trying to get $8 billion out of Silicon Valley Bank on that. They sent the wire instructions on Thursday night. One guy I talked to said, hey, Jim, from Thursday night to Sunday, we didn't know where the money was. We sent the wire instructions. We were trying to get it out. But we didn't know what the outcome was going to be, whether it was short or not, wire sent or not. And then Sunday night, the Fed and the FDIC came out and said, all good. We're going to, business as usual, open Monday, and it's all good. And he said the money went through. But that was what, people were facing, and they'll continue to face. I mean, the banks you mentioned, I don't know what their deposit flows are right now, but my guess is they're shrinking fast. People are getting their money out. And so you might just have to give a generalized blanket deposit insurance protection, and that would stop bank runs in theory. But then now you basically nationalize the U.S. banking system. You look like Argentina. So there are I guess the way to put it, Matt, there are no good outcomes. Either there's a catastrophe worse than 2008 that starts to look like 1931, 32, or the government offers so much protection that they've de facto nationalized the banking system. And one just quick note I would add, I think when it comes to banking crisis, I'm a little bit of a magnet for trouble. I remember the Herstatt Bank collapse in 1974. That was a foreign exchange crisis. But through the early 80s with the Latin American debt crisis, and the late 80s with the S&L crisis, and then 1994, the Mexican tequila crisis, with the collapse of the peso, 1998, long-term capital, dot-com, 2007, 2008, we talked about that. And today, when, October 19th, 1987, the stock market fell 22% in one day. Not a year, but in one day. So I've been on the front lines of all those. But the one thing I've noticed is that each crisis gets bigger than the one before. And each bailout is bigger than the one before. And the question I'm asking as an analyst is, are we at the point where the crises are so big, it's bigger than the Fed? In other words, we're not really talking about bailing out a bank or a sector. People lose confidence in the dollar itself. And we do seem to be heading in that direction. Yeah, I mean, you can think of the dollar and gold as kind of two sides of the seesaw. One's up and the other one's down, and then vice versa. When people talk about the price of gold, it's really the dollar price of gold. You can think of gold by weight. So, yeah, a strong dollar usually means a lower dollar price for gold, and a weaker dollar means a higher dollar price for gold. And we've seen that dynamic play out in recent months. It's not the only driver of gold. It's one of them. There's a good old-fashioned supply and demand. I think in a bank, sometimes you see in a financial panic, gold and the dollar will both get stronger. The dollar will get stronger against other currencies, and gold will get stronger measured in dollar terms because there's a flight to quality. Get me out of, yen or yuan or rubles or euros or whatever else it might be. Get me into treasury securities. And the thing about a flight to quality, it plays out in security space. What you want to get are really treasury securities. You want to get really short-term treasury bills and treasury notes. But to do that, you need dollars. If you're a foreign banker or foreign investor and you want to buy some 4-week treasury bills, you got to get dollars to pay for them. So the rush into safe treasury securities creates a demand for dollars. And then at the same time, gold is another saving. So sometimes it's the seesaw. Sometimes they can both go up at once. I guess what I'm really saying is that I see gold getting stronger. The dollar is very much in the news. It's one of the questions I get most frequently. You talk about Ukraine or China or inflation and all that, but it usually comes back pretty quickly to the dollar. But I find there's a lot of confusion on the topic. And the confusion comes from the fact that everyone talks about the end of the dollar, the dollar is going away as a global reserve currency, etc. But people don't distinguish between the role of the dollar as a payment currency and the role of the dollar as a reserve currency. And those are two very different things. There's some linkages, but a payment currency, basically, if I want to buy goods and services from you, and I tender some form of currency and you're willing to accept it, and you're confident someone else will accept it from you, that's a good payment currency. It could be dollars, it could be euros or yuan, or it could be Russian rubles or Brazilian rice or anything, as long as people are willing to accept it, have confidence in it. And when we were kids, we'd use baseball cards and bottle caps. So almost anything can be a reserve currency. You need payment channels, and there's a little more to it than that, but that's basically it. A reserve currency is a very different thing. First of all, we don't really have reserve currencies. You go to the People's Bank of China, they don't have $100 bills stacked up in the basement. What they own are U.S. Treasury securities, which are digital, by the way. The last paper Treasury security was issued, I think, around 1979. So what they have are actually securities. So when people say reserve currency, what they really mean is securities that hold your reserves denominated in a currency. So, of course, Treasury securities are denominated in dollars, but they don't have actual dollars, in a bank account or a physical form. They own securities.